You know, we bought $62 billion of Bitcoin. We're the biggest buyer of Bitcoin in the world. We will probably continue to be ad infinitum the biggest buyer of Bitcoin in the world.
Thank you, Michael, for having CoinDesk interview you. How's everything going?
I think it's awesome. I mean, it's been 2026 is, I think, a great year. It's really exciting. Our digital credit product Stretch has exploded in popularity. And I just finished speaking and meeting with a bunch of people at Consensus down here in Miami. And it was my first time at Consensus. And I think you could summarize what's going on here is the convergence of TradFi and DeFi through digital credit and the convergence of Bitcoin interest and crypto interest through digital credit. So I think that the industry's moving together with more enthusiasm than any time I can remember.
I couldn't agree more. I kind of want to go back to your earnings call and if we could decipher like a 2 minute, or if you could shrink it from a 2 hour to 2 minute, but how I would decipher it is, as an operating company, you're now more as I'd say a hedge fund, quote unquote. So it's selling high cost basis Bitcoin. I think there was $14 billion cost basis above 100,000 Bitcoin. You've got your tax loss harvesting. And then once you book profits, you then have the optionality to then go into common stock, retiring your converts, issuing digital credit, or buying Bitcoin. Is that a fair synopsis of a shorter?
Yeah, I think the summary of the call is that the company has lots of different treasury operations that it can engage in and many, many assets to manage. And we were working to communicate all the various trades and all the various capital markets activities that we thought were rational in the best interest of the shareholders. At the high level, the company balances the interest of the equity holders with the capital investors with the credit investors. Bitcoin is capital. We're always interested in what's good for Bitcoin. STRC is credit. We're interested in what's good for the digital credit. And then MSTR is equity, digital equity, and we're interested in what's good for them. Traditionally, we've been engaged in just a few simple activities. We sold equity to buy Bitcoin, and then we sold credit to buy Bitcoin. And most of the world just focuses upon that. But now we've reached the point where we want to accelerate the growth, improve the balance sheet. So one of the aspects we covered was our bonds. We have 6 convertible bonds. We told the market previously we won't sell them. But now we've moved beyond that. We won't sell bonds anymore. We think it's time to retire the bonds, and we have options to retire the bonds that we didn't have a year ago. Stretch didn't exist, but STRC has been so successful. It's generating billions and billions of dollars of capital for us that we have options like we could swap the STRC for the bonds, and many of the bonds are very much undervalued. They're over-the-counter bonds, and because they trade over-the-counter, it's impossible for retail or public investors to buy them, and so they trade at a deep discount to their fair value.
Well, I did notice, that when obviously strategy stock was down 83% peak to trough this cycle, Bitcoin was down 55% peak trough, but your first convertible note, which matures, I think, say 2028, was still trading above par. Is that something that surprised you?
I mean, the senior bond is sometimes between 50 and 80 times over-collateralized. So in theory, it's almost a risk-free bond. And so if you have the analytics to calculate the credit spreads on these bonds, which it's complicated to calculate because they have a very substantial warrant component to them, your conclusion is that they're all investment grade and they should all be trading at a substantial premium to par. And most of them do, but not all of them do. But coming back to the investor call, I think the real point there is the company's reached the point where it makes sense for us to think about retiring the bonds using STRC proceeds. The company, because that's a big asset of the company now, the option to sell stretch.
So would you say on a Bitcoin per share basis, retiring convert, buying MSTR below a 1.22x MNAV, or buying Bitcoin, if they were all the same Bitcoin per share, what would you prioritize? Would it be retiring the
well,
convert?
I mean, the truth is, if they're all exactly the same,
But do you have a
they're all
preference?
exactly the same. When we calculate the impact on
would retiring
Bitcoin per share, we're always looking for things that create yield. So we would prioritize trades that create more Bitcoin per share. And if we can create 10x more Bitcoin per share,
Yeah.
we prioritize that first. So for example, if the common equity trades at a massive discount to parity or fair value, then that becomes an interesting trade. And the trade could either be we trade dollars for the stock, we trade Bitcoin for the stock, or we trade credit, STRC, for the stock. And each of those has a different characteristic. So what we presented in the earnings call was two things. We presented the options we have in front of us, and then we also presented the metrics we use to make the decision. The options are to retire the debt earlier, to buy back the stock, or to buy Bitcoin. Generally, those three. The way in which we do it is: do we use dollars? Do we use Bitcoin? Do we use credit? Or do we use equity? We have all of these things, and then the metrics we use are equity and credit metrics. So the first question is: what's the yield, the BTC yield? What's the benefit to the common equity shareholder? So if there is no yield, then it's equity neutral. If there's a negative yield, it's dilutive. If there's a positive yield, it's accretive. And then the second metric is credit. What is the impact on the credit of the company? Does it create more risk on the balance sheet? For example, if we used all of our dollars to buy back stock, it would be equity positive. It would create a yield, but it would be credit negative. And so the market price of the stock, of Bitcoin, of all of our credit instruments, of all of our bonds is changing every day. And from day to day, we adjust our capital markets activity in order to take advantage of yield opportunities, and then to meet any of our liabilities. So the primary thing we're doing, we're raising 20 to 30 billion of capital a year, and so when we're raising the 20 to 30 billion of capital, the issue is: are we buying Bitcoin, or are we adding dollar reserves, or should we go and buy the debt, or should we go and increase the reserve, or should we buy our equity? So this is the primary, the first order thing we do, and this is where we generate. If we generate $10 billion of BTC gain on a Bitcoin standard, that's like $10 billion of net income. So the first order interest of the company is to generate the net income equivalent for the equity. The second order impact, or the second order obligation, is, well, we have about $1.5 billion of dividends. So we have to decide, how will we fund the dividends? Shall we use dollars? Will we use common stock? Will we use Bitcoin? And what we laid out to our investors is, we have a lot of options for meeting obligations. We have a lot of different trades. We can go fast. We can go slower. We have the option very often to do very little. We could, for example, turn the engine down by a factor of 20, or we can crank the engine up. And so we presented our enterprise equity models and risks models so that the investors will understand how we think about it. And we wanted to communicate that we've traditionally run on about 3 engines, and now we're expanding to about 8 engines. So we have many, many more engines of growth that we can deploy in order to create shareholder value.
In terms of leading up to the earnings call, and then knowing that, I think anyone that's been observing the stock, that selling Bitcoin is something that probably could have happened, would have happened eventually, but announcing it, were you surprised how well, one, Bitcoin's held up, and two, the common stocks held up?
I didn't expect Bitcoin to, the price of Bitcoin to change at all on that announcement. The truth is, if we were to fund all of our dividends exclusively by selling Bitcoin over the next year, we would buy 21 Bitcoin for every 1 Bitcoin we sold. And so it's no different than buying 20 Bitcoin and selling no Bitcoin, buying 21 Bitcoin and selling 1 Bitcoin. So it's kind of a big nothing burger from an economic point of view. And then from a market point of view, the Bitcoin market has somewhere between 20 and $50 billion of liquidity a day. And if we were to, if we were to fund all of our dividends with Bitcoin, you would be talking about 3 million. It would be divide 3 into 50, into 50,000, right? If you can do the math in your head of what is 3/50,000th of the market, it's not, measurable. It's immeasurable. So it's really inconsequential. The whole reason we're confident about Bitcoin is because it's a global market. We have announced we're going to buy 42 billion of Bitcoin. The market goes nowhere. We have literally bought 200 million an hour. The price does not move up. We have stopped buying. We have bought 200 million an hour for 4 hours and turned it off, and the price trades up. And so the truth is the market has its own dynamic, and we are a part of it, but we're definitely not driving the price. It's really more driven by macroeconomics, I think.
So just leading on to my next question is, so the criticism is your company, say, buys the weekly high. Could you tell us a step-by-step on how you issue or sell the common or sell the preferred?
Yeah,
and then how do you buy the Bitcoin via OTC? Or
that's an ignorant criticism that trends on X, but the people that observe it really aren't deep thinkers, nor do they analyze things. What's going on here is when we're buying Bitcoin with an equity swap, it's because the equity rallied and then there's a massive equity premium. And if you actually thought about it, you would realize that when Bitcoin surges, the equity surges and the premium expands, and it actually becomes more profitable for us to and we're not buying, we're swapping. We're swapping a share of MSTR for a share of BTC when the premium expands, and that's when the Bitcoin rallies. So in a week of 168 hours, there might be 3 hours that week during which the markets rallied, and we might do $250 million of swaps in the 3 hours. So yes, we're picking the top of the Bitcoin market, but we're also picking the top of the equity capital market and swapping the two of them, and we're actually generating a much larger gain. So we're making money for our shareholders risk-free by doing these swaps. If we wanted to do those swaps when the price is low, the premium is low. The truth is, it makes much less money, or we would lose money for the common by swapping the equity when the Bitcoin price is low. So that's why it sort of appears that we might be buying the top, but we're not buying it with money that's been sitting around. We're swapping equity at a premium, which is exploding when we're doing it. And so we do that because it's equity positive. When the equity premium is compressing and our equity is underperforming, we exit the market to support the equity, because the last thing in the world you would want to do is sell equity when your equity is underperforming the Bitcoin. Now, the stretch dynamic is different. When STRC hits par and is trading at 100, we are selling STRC and we are buying Bitcoin, and we're hedging that in the hour. So if someone actually buys $100 million of stretch at 3 p.m. on a Tuesday, we're buying $100 million of Bitcoin at 3 p.m. on a Tuesday. And you'll see when our purchases are based upon selling the credit, probably the price we get is the price in the market at the time we're selling the credit, because we want to always stay hedged. And when the purchases are based on equity sales, we're probably getting the price of Bitcoin when the equity premium in our stock was the highest. And generally our view is we want to always stay long exposed Bitcoin. We don't really trade the market. If we have a certain amount of Bitcoin per share, if we're doing anything, we're increasing Bitcoin per share. Yeah. So what we wouldn't do, for example, is we're not really enthusiastic about selling $1 billion of equity, not buying the Bitcoin, and then waiting to see if we get a better price. Because if we were to do that, it creates opacity and uncertainty, and that's really not good for the derivatives traders that make a living trading our stock. It's not good for our equity investors. We are in business because people trust us, and we are transparent. And that's why we have the largest spot liquidity for an equity. MSTR trades more than IBIT. And that's why we have the largest open interest in the options market. It's because everybody knows we're going to stay directionally long. If we start to act random, or we start to act like a retail trader who gets up every day and thinks, well, maybe I'll do this, maybe I won't. Well, that's a rational thing for a retail trader or an individual trader, but it's actually irrational for a public company. We are creating securities that 10 million other people are trading, or 10,000 other traders are trading. Our job is to be consistent and transparent and predictable to make their job easy. And if we start to be not consistent, we make their life hell. Yes. And so if the company were to do something that was opposite of what they expected, that's like a rug pull, they would take all their money and go home and say, well, we're just not going to trade this anymore because we don't know what the company's going to do. So we have earnings calls like this. We're communicating to all those investors, the bond holders, the credit holders, the equity holders, the derivative, the call options, the put options. We're communicating to everybody. This is what we expect to do. Now you can create your trading strategy. And there's no greater compliment, by the way, than someone that says, oh, I took $1 billion short position because I trusted you not to unwind yours, right? Or I took they're betting $1 billion. The day of our earnings call, the largest options trade in the entire US stock market was an MSTR call option trade placed by a derivatives trader, like more than anybody. And so that's a burden of trust we carry. And so we try not to be traders. We're not being cute. We're not dancing around. When we're swapping credit and equity instruments, we're doing it algorithmically so that like I don't want to go to bed short where I'm like, oh, I'm $1 billion short and Bitcoin rallies $8,000 and oh, now I got to buy it $8,000 higher. Yeah. Right? It's like, that's not the business we're in. We're not traders. We don't take that kind of risk. We're very methodic in the way we operate our capital markets programs.
No, that's a very fair answer. So with the 2.2 billion tax loss, so while Bitcoin now is, say, depressed in price, 37% from its all-time high, would this be a good time to sell high cost basis Bitcoin? Is that something that you're looking at? And also, is the tax deferred within this calendar year, or is it rolled over into other calendar years?
We have the option to capture that up to $2.2 billion tax credit. The value of the credit's changing every day, every minute, right? And we also have the option to calculate the mispricing of the convertible bonds, and there's a massive yield in that. We also have the option to capture Bitcoin in a trade. We make that decision week by week, day by day. Generally on a weekly basis, we think strategically. On a daily basis, we make our capital markets decisions. And we may not. Everything we do precludes us doing something else. And so we always have to consider Is this equity positive but credit negative? Or maybe it's screamingly good for the equity. It makes us $500 million, but it's a little bit bad for the credit. And so would I do that? Well, if the credit was super strong, then I would do something equity positive, slightly credit negative. If the credit was super weak, we wouldn't.
Yeah.
Right. So sometimes we do things that are bad for the that are equity negative, that create a negative yield. For example, last year we raised $2.25 billion in US dollars. That was a negative yield, but it was important to bring the credit to life. And so,
is it possible to ask where that cash is held? Is that just on the balance sheet? Is that sitting generating yield?
We normally sit in money markets. So we're in the same T-bill money markets that anybody else with a large amount of corporate cash would be in. I think the point to be made there is, if we think we need to support the credit, we do it. When we did it, it was equity negative, but then in the first 4 months of this year, we generated $5 billion of credit sales, and we generated a $4 to $5 billion Bitcoin gain. That's a net income equivalent. If you think Bitcoin's gone up 11% a year, when we book a $5 billion BTC gain, it's $5 billion in net income. If you think Bitcoin's gone up 22% a year, it's $5 billion in net income with another $5 billion coming over the next 7 years. And if you think Bitcoin's going up 30% a year, it's $5 billion up front, $10 billion on the back end. So sometimes we trade off a negative in order to, in the present, to get a positive in the future. But on the other hand, if the credit markets change, then we might go back to the equity, and then the Bitcoin markets also have an impact. So we have to weigh all of these things. I think the real message for the marketplace is we think about the equity, we think about the credit, we think about the Bitcoin. Everything we do, over the long term, it's certainly Bitcoin positive. We bought $62 billion of Bitcoin. We're the biggest buyer of Bitcoin in the world. We will probably continue to be ad infinitum the biggest buyer of Bitcoin in the world. In the near term, there's a lot of volatility. And if you look, the stock traded down 70% at one point.
In your stock, you're saying?
In the near term, there's a lot of volatility in the equity, and there's some volatility in the credit. So the things that are moving that we have to manage week by week, month by month, are normally the credit equity balance. Whereas with Bitcoin, it's generally just a slow driving drill bit. We just keep cranking that. And the issue is just, are we doing 20 billion a year, or 30 billion a year, or 10 billion a year, or 50 billion a year? And the rate at which we do all these things is a function of the equity capital markets, the macro economy, the credit markets, and the crypto capital markets, the Bitcoin market. And we are a player, but at the end of the day, macro headwinds, trade wars, hot wars, currency wars are the big boss. And then industry dynamics like the passage of clarity, banking credit, they're also a factor. And then our execution on digital credit is the third factor. And if we ran the business just for the credit, it'd be not good for the equity. The equity would trade at a discount to MNAV. And if that happens, then the credit doesn't work over the long term. So we have to always be thinking about the harmony and the equilibrium between what's credit positive, what's equity positive. And if we hit the right balance, everybody wins. It's great for the credit, it's great for the equity, it's great for Bitcoin. And if we get it wrong, if we're unhealthy and we fall out of balance, then we won't sell any credit. The equity premiums fall, and we won't buy much Bitcoin. And so it's bad for all three constituencies. And so that's how we think.
I think it even shows that in Q1 of this year, we had a 50% drawdown. Obviously, it started from October, but I think it was like your second or third best quarter. You bought 34,000 Bitcoin in 1 week a couple of weeks ago, which was your third biggest purchase in a week. So it's quite incredible to see when you do compare 4 years prior to like 2022, where you made what, 5-6 purchases of 10,000 Bitcoin, I think that's the growth or the barometer you should be doing, like bear market to bear market, or like monitoring your position over like a 200-week moving average. Like that's how, as a shareholder, you'd look on the improvements.
We have evolved through about 15 iterations of capital markets activity over the last 5 years, and we've lived through, it's like 4 bear markets where we had big drawdowns. I think in a bull market, the equity runs, and it's a fairly easy business. It's in a bull market, it's easy for everybody. Everything works. And, we had a bull market like, after the November elections in 24, and we sold $21 billion of equity at something like an MNAV of 2 to
50% dilution
3
announcement or something.
But that, I mean, we basically sold $21 billion of equity and created a $14 billion Bitcoin gain in a matter of weeks. It was a go-go time. And so in a bear market, we've been in a bear market for about 6-7 months. The credit, is the idea, but what we found is bonds wouldn't work in a bear market. STRC, digital credit, if properly managed, does work in a bear market. And so we've been able to use STRC in order to drive Bitcoin yield and Bitcoin acquisition in the bear market. Now, we've never had, and by the way, so we invented our way to drag ourselves out of a bear market, right? STRC was like the 14th thing we invented. After we done, they say Americans do the right thing after they've done everything else, right? After we've done 14 other things, we finally found Stretch, and Stretch started working, and just in the past 3 months, it's working pretty well. But we have not ever had a bull market where we had the equity engine firing, and we also had the credit engine firing, and we had all the open market activities working. And so I think that the best is yet to come. We're looking forward to that that bull market where we'll be able to actively use all these tools. And the other observation, we got 4 other prefs: Strike, Stride, Strife, Stream. Those are really bull market type things. And if a bull market comes, they actually should become interesting programs for us.
Sorry, as a side note, for someone who is from the UK, European, what have you learned from Stream? What have you seen with the almost illiquidity of the European markets?
The European markets are fragmented. There's like 18 different capital markets. There's 18 regulators. There's 18 different exchanges. And you would think that the EU would have consolidated all that. That did not happen. It's all very balkanized. Here's what I've learned. The most advanced, sophisticated capital markets in the world are the U.S. The U.S. has preferred stocks. It has shelf registrations. It has flexible shelf registrations for preferred stocks. It has a lot of liquidity. It has sophisticated banking, sophisticated distribution. It has a single currency, single language, single set of regulators. That it has pretty stable, flexible, exchanges like NASDAQ. When you go to other parts of the world, they're not progressive. They don't have shelf registrations.
Yeah, you should see the UK markets, absolute disarray.
Yeah, they don't move quickly. We have a natural advantage in the U.S. because we're a well-known seasoned issuer, a WIXI, which means that's a designation given to publicly traded companies in the U.S. that have been in the market for a long time. They're well-known seasoned issuer, literally what the word suggests. It means you can file a registration statement and you can sell securities the next day or the day of. So you can go very quickly. Going to the UK, we might wait a year. Going to Japan, we might have to set up a company and wait 3 years. And so when we did the Stream deal in Europe, we listed it on the Luxembourg Stock Exchange. It was the most flexible, but it's not a transparent exchange. I barely see a bid and an ask. It's more like an OTC market, which surprised me. But after the fact, it's not terribly liquid. It's not transparent. It's not very functional. And so we've worked to list on other exchanges in Europe. It's slow going, working through regulators. You have to get regulator permissions, exchange permissions. My conclusion is that 80% of all the capital in the world is going to circulate on U.S. capital markets. The big winner here is the U.S. The big loser is every other nation, right? And it's just, if you strategically make your markets not work, money is fungible, and so the money just flows to the market where it does work. And right now, the two most advanced markets in the world are USA and UAE, but they're the most progressive. But at the end of the day, the USA has the combination of issuer power, liquidity, progressive regulations, and good infrastructure. And so it is the market that's growing the fastest and will grow the fastest, I would anticipate.
Yeah, and as a UK investor, that was our jurisdictional arbitrage. We could see it in October 2020 when the FCA banned crypto derivatives and ETNs, and you came out 2 months before. So for anyone in the UK that was in Bitcoin, it was just an easy transfer. And we definitely contributed, I believe, to the huge MNAV expansion.
So you ended up an investor in MSTR, my company,
there's
because
no
you didn't have an alternative in your country, right, in the UK. So it's
what the FCA have started to do again is in August, September of last year, they issued the ETFs, which we could start to buy in.
Right.
And I do believe that the MNAV contraction actually in your stock was maybe a contributing factor. Same with when Stretch also, I believe there was some arbing there. But again, the UK FCA have kind of banned ETFs again. So that could also have contributed back to an MNAV expansion. It's literally you're trading between legal rules and jurisdictions. It's just wild. It's nuts.
To this day, I meet lots of Brits, like lots of people from the UK, and they say, yeah, I discovered your stock in 2020 because we couldn't buy Bitcoin.
Yeah, you didn't have to be a genius.
Which is interesting. So we ended up with a lot of investors and a lot of fans from places that I had no idea, like how do they even know we exist? And it was because we were a proxy that they could get to. We see the same thing with Stretch right now, which is Vanguard won't let you buy Bitcoin, but they'll let you buy STRC. Or let you buy MSTR.
And the UK has return of capital as well now. Well, that's what we found out. So when you buy Stretch, it's the same as the US, which is one of the advantages that we've had. So that's quite good.
At the end of the day, it's a reason why you need to have securities like a digital equity and a digital credit. I mean, if you're a Bitcoin maxi, what they don't realize is there are a lot of people that have money stranded or tied up in accounts where they need to buy a security, and there are either tax benefits or they literally cannot buy the commodity. They can't buy the crypto commodity. They have to buy security that's listed on a Vanguard or listed in a retirement account in the UK. I meet people in Europe and they're like, I have money in a retirement account. I was able to get into your stock, but I couldn't get it to BTC. So we're offering a useful function to the world among other things.
Yeah, and it's definitely the liquidity, because the liquidity is so short in Europe and the UK. That's one of the most important things. And then obviously you've got your bi-monthly dividends vote coming up. And Stretch hasn't actually approached par yet. And I think 15 days after the ex-dividend day. It's now 5 days on average. I think that it's around 10, 11 days it takes. And it's now quite a few days after. Is that anything that you've noticed with that, or why it's taking a bit longer to par, and what are your expectations on the bi-monthly dividends?
I think you have to just look at it in full monthly cycles, because we won't know how much STRC we sold in May until the full end of the cycle, because it could be 100 million in a day, it could be $1 billion in a day, it could be 2 billion in a day. And I've watched it, we sold $120 million at 3:59 and 57 seconds. Like we're at 3 seconds before the market closes, and there's a blip, and an extra $120 million crosses the wire in 1 second. So, you don't really know what's going to happen until the end. So I don't know what the forecast is. When I look at the chart, January was like a $500 million month. February, there's a massive crypto crash, and Bitcoin traded down like around February 4th, the
60,
biggest
000.
one day ever.
That was on, the bottom coincided with your earnings call. And I thought that was just because all the tweets.
Yeah, like February 4th, February 5th, something.
Yeah, and it was actually my pinned tweet. It was like, it's just full de-risking going into your earnings call, because all the announcements were MSTR was down 6 billion unrealized loss, and it was just like pandemonium. And it felt like a great capitulation.
Yeah, I'm flattered, but I don't think that's why it traded down. I think it traded down because of the flare-up and the Gulf War, right, and the Iranian war and the crisis in the Straits of Hormuz and foreign policy and trade policy. The macroeconomic effects generally trump any microeconomic thing. I mean, our announcement would be a mark-to-market, and it's not even news. You can literally mark our Bitcoin to market every 15 seconds. There is no news there. The news generally is a presidential tweet, or either a loosening in trade tension or a tightening in trade tension, and that drives massive levered 50x, 100x trades, short and long. But in any event, let's come back to February, because the point is, January is about 500 million. February, we had a massive Bitcoin crash and a ratcheting up in macro tensions, and we only did 70 million. It's almost like the credit markets seized up. In March, everything got a bit better and people relaxed, and then we had a $1.5 billion month. And then in April, that went to 3.2 billion. So if you were drawing a straight line, if you didn't have the macro headwind, it might have been 500 million to a billion to 1.5 billion to 3.2 billion, which you would think would be about rational. But now we have to watch and see what happens in May, June, and July. And the question really, like 1.5 billion is an $18 billion run rate, which we'd be totally happy with. If we had sold $18 billion, if we told you we were going to do $18 billion in credit and probably $18 billion in BTC gains this year, you'd be like, whoa, that's good. And then when it went to 3.2, that's a $38 billion run rate. So now we're sitting between 18 billion and 38 billion in May, June, July. If it's somewhere in the middle, I don't think there's anything wrong with that. It'll be perfectly fine. Will it go? Will it grow? Will it shrink? We really can't know, because a lot of time, if you're a credit investor, if you wanted to buy $1 billion of this instrument, there's no difference between, if you buy it today, you'll get a 3-cent discount. It's trading at $99.97.
Yeah.
And if you wait until 3:59 and 58 seconds on the last day, you would pay $100. Or maybe you could buy $1 billion of this at $100.01 if you wait till the last minute. So the truth of the matter is, maybe you just want to wait till the last minute, and that's what we saw last month. So speculating linearly makes no sense. You know, why is it trading the way it is? I'm pleased with the way it's trading, because it's basically traded with a 99 handle ever since our dividend record date. And
you've kept it consistent for the last 3 months, and I know
kept the dividend rates consistent. Yeah, which I think is important, because it's trading in the 99 to 100 range, and so it's perfectly healthy.
If I had to, this is an impossible question, but say 6 months, 12 months out, you obviously want to get the rate lower. Do you have a forecast or a number that you'd love, or it's just month by month? It's so early.
Yeah, let me finish with the other point that I want to make, which is we sold $3.2 billion in a couple of weeks on an instrument with a basis of like 5 billion. So we expanded the supply by a huge factor, by 3 billion on a $5 billion number. So it was a massive month-over-month growth. And so it doesn't surprise me that it takes a while for the market to digest that, right? Some of that was certainly people that were buying $1 billion to to clip a 90-cent dividend, and then they're ready to sell, and then they're coming back. So the way it trades is going to be a function of the growth rate. If it was growing 20%, it would trade much closer to par with much less of a drawdown, I think. But if it's growing 200%, there's going to be more pressure, and we're at almost a 400% rate. So given the hyper growth, it doesn't surprise me that it's digesting that. I think it's actually behaving pretty well, and over the past few days, it's trading with a 5-cent spread, 5-cent daily range and a 3-cent daily range yesterday. So all of that's comfortable. Now, coming to your next question. We think that, the dividend rate seems healthy right now. Our bias is to grow the business. The more capital we raise, the more BTC gain we generate, the more Bitcoin we buy, the higher the Bitcoin price goes. So generally, if the credit demand remains strong, that's probably because Bitcoin is strong. And if Bitcoin rallies, our collateral base will grow. And so if all of those things are growing in a harmony, then we'll just continue with that growth path. I'd rather buy $40 billion of Bitcoin, issue $40 billion of credit, and pay 11.5%, than buy $10 billion of Bitcoin, issue $10 billion of credit, and pay 9.5%. You see, so we're, at the end of the day, we kind of view this as we're in the growth stage. And the analogy is like Amazon offered free shipping, that people said, well, they must be losing money on this. And they did it for like 7 years, a long time, until every household in the United States was an Amazon customer. And then when every household in the United States was an Amazon customer and they had won the market, then they raised the price of Amazon Prime, and people are like, oh, wow, that's obscenely profitable, right? So I think right now we're offering a dividend which is more than the fair credit spread. If you believe the Bitcoin is appreciating 10 to 15% a year, if it's slightly better than the S&P, then our credit should be investment grade. So investment grade credit spread is 80 basis points, and we're obviously paying a lot more than investment grade. So we're overdriving the market, and it's good for the credit investors. It's good for us. It's good for Bitcoin. And the real issue is how is the equity capital market going to react, and how is the Bitcoin market react? And so if we sell a lot of credit, we buy a lot of Bitcoin, and Bitcoin is healthy and the equity is healthy, then we run the engine as hard in fifth gear.
Yeah.
And if it turns out that Bitcoin, for whatever reason, languishes, and the equity languishes, then we would turn a gear down. But I don't think that'll happen. The truth is, I think for the next 3-4 years, we're just going to run the engine, in overdrive, in a high gear. I think we're going to issue a lot of credit. We're going to buy a lot of Bitcoin. The price of Bitcoin we're going to go back into a serious bull market. I think the equity premiums are going to expand. I think the MNAV's going to expand. I think we're going to have, at 125,000 a Bitcoin, all of a sudden we've got pretty soon we'll have 150 billion, 200 billion of collateral. And as our Bitcoin NAV expands, our capacity to issue credit increases. The other thing I think is the bigger the digital credit business and the more Bitcoin we buy, the lower the volatility of Bitcoin. I think that Bitcoin is naturally destined to move from, right now it's 40 vol on a trailing 1 year basis.
Yeah.
There's no reason why it can't move down to 35.
Yeah. Well,
and if you
went into the 30s last week.
If you go to our website and you plug into our credit model, when it goes from 40 to 35, the credit spread is cut in half. Well, you go from a fair credit spread of, say, 100 basis points to 50. And so the difference between a 30 vol asset and a 35 vol asset and a 40 vol asset is tremendous. So our thoughts about how much credit we issue is really a function of the forward price curve of Bitcoin and the forward volatility curve of Bitcoin, as well as the equity capital markets premium of MSTR. And finally, what is the credit industry's view of Bitcoin as an asset, right? As Bitcoin is legitimized as collateral asset in the banking system and with the credit rating agencies, then you'll start to see the haircutting they give it decrease, and that would be enormously credit positive. So, I think right now you ought to be thinking that we love the idea that stretch goes to 11. I think 11 is great. 11 and a half is even better. And that's the products. We're not trying to pay the credit investor the least amount we can pay them. We're actually enthusiastically embracing the idea of providing the best credit in the world with the highest Sharpe ratio. We want to drive the vol from 3 to 1.5. We want to hold the dividend constant. We want to jack the Sharpe ratio to 5, 6, 7, or 8. We want the entire world to say this is the best credit, the most liquid credit, the highest performance credit in the world. And you got to keep in mind, we have $4 or $5 of Bitcoin for every dollar of stretch, right? Which means that if Bitcoin price appreciates by 50 basis points, we actually make a 200 or 250 basis point spread against the credit. So the truth of the matter is, we're interested in doing what's good for Bitcoin, and we're interested in what's doing good for the equity, right? When we sell double the credit, we make $20 billion in the year instead of $10 billion in the year, right? There's nothing wrong with that. And then, of course, the last piece of reflexivity is you sell $20 billion of credit instead of $10 billion of credit, you're going to $2 billion of daily liquidity instead of $1 billion a day of daily liquidity. And that is reflexive to the demand, because the world has infinite money. I mean, relatively speaking, there's $30 trillion in a money market. So let's say you're a big corporate buyer and you have $500 million of capital, working capital. You think, well, how much stretch should I own? Yeah. Well, you're thinking, well, if I need the money next week, then I don't want to buy more than, say, 10% of the daily liquidity. So that company will say, well, you're trading $400 million a day. We'll buy $440 million a stretch. But when we get to $1 billion a day, that company will say, we'll buy $100 million a stretch. And when we get to $2 billion a day, that company it's the same exact customer. They're increasing their allocation based upon our liquidity. And when they do that, the volatility is falling. So all of these metrics, the demand, the volatility, the liquidity, the Bitcoin price, the equity premium, all of those are integrated. And what's in our best interest is just to be a consistent, reliable partner. If you're a credit investor, we want to give you the best credit in the world, right? And if you're an equity investor, the same. And so we'll just be continuously driving the market. If we get to the point where we've issued $1 trillion of credit and the company has an equity market cap of $3 trillion, right?
Yeah.
And we lower the interest rate 25 basis points, we're going to make an obscene amount of money for our equity shareholders in that 1 month. People are going to go, oh my God, right? They just made billions of dollars for the equity overnight. And that would be equivalent to Amazon having 250 million Prime customers and saying, we raised the price from $10 to $11. But you can imagine the time when I want to do that is when we own the market. Like when 5% or 10% of the entire credit market or the treasury market is flipped to digital credit, we might, and by the way, we would only do it if the Bitcoin economy slows down. If Bitcoin's growing 30% a year, we're just going to continue to drive the credit here. But let's say Bitcoin backs off and Bitcoin's only growing 20% a year, right? Then it's kind of like, you know, if you're the central bank of Bitcoin or the reserve bank, you might think, well, we're going to slightly lower the interest rate to keep things going and not overheat. But that is so many years in the future. And that is when Bitcoin's $1 million coin and we're 10 years out, and then we can talk about it. Right now, the number one thing we look at is, are we trading in the 99 to 100 range, you know, and are we just kind of, is the vol good? If the vol explodes in the wrong way, not good. We want the vol to continue to fall, the liquidity to grow, and we want stability to be paramount.
With Stretch, it's an 80% retail, 20% institutions, I think, at the moment. And do you think a credit rating is where it takes you from A to B? And is there a certain amount of trading volume that Stretch needs for more institutions to be comfortable?
I think Stretch is going to grow, hyper grow, regardless of when we get a credit rating. If you think about this, there's $3.7 trillion of private credit. It's illiquid and it yields 8% and it's taxable. And we're offering 11.5% tax deferred, completely liquid. Grab 10% of that, that's $370 billion, right? The amount of money that's out there in the crypto community, digital assets, and junk bonds, and private credit, and hedge funds, and equity is so large, we could sell $1 trillion of STRC without a credit rating. And clearly, we're not going to sell it to a regulated, risk-averse, traditional credit investor that's waiting to be told it's okay with S&P. But, you know, if there's $300 trillion of credit capital and $100 trillion of equity capital, out of that $400 trillion, 10% of it thinks for itself, right? So there's $40 trillion out there, $50 trillion that doesn't need a credit rating to even think about this. So there's a very large addressable market, and digital credit is exploding for that reason right now. What I would say about our holdings is we measure, I would say 80% of STRC is in retail accounts, but that is really more properly articulated as 80% of the long-term holders are retail, right? Because if you're a hedge fund, you buy $100 million of STRC on Tuesday at 100, and then you sell it on Wednesday at $99.80, and maybe you made 15 cents by holding the instrument for one day, and then you do that 12 times a year, right? And you tell yourself that that's kind of interesting for you, and that works out to be an annualized 40% or 80% return by your trading it. When someone does that, they're not following a 13F. So actually, they're not a shareholder necessarily at the end of the quarter. They might be a shareholder of record where we pay the dividend, but they're not shareholder of record at the end of the quarter where they might file, or the 13F period. So we're not going to see those investors. So it's not, strictly speaking, true to say, well, 80% of all of the investment is retail. The truth is 80% of the investors that don't want to trade it are retail. But one of the benefits of the instrument is that everybody else does want to trade it, and they may come in and they may go. You could literally, one of the things about the instrument, which is kind of good, it's a feature. If you understand it, you could think it's a bug, but it's a feature, is because it's stable, it means that an institutional investor could buy it, hold it, clip all the coupons, sell it before the 13F date, buy it back after the 13F date, and no one would know. Yeah. And so it's not always going to be clear who's in and out of a digital money market type fund, because the whole point is it's meant for high frequency moving in and out. And we welcome that, right? It's good for us, right? They're creating liquidity. And so I think over time, the bigger question is, where's the growth going to come from? In retail, it's spreading virally. Like, I literally meet people and they're like, yeah, I told my parents. I told my sister. I told my cousin. I told my uncle. Yeah, I told my kids they should buy. It's spreading virally via word of mouth. The second way it's going to spread is corporations. Corporate treasuries are allocating, and that will spread through the corporate process. The third way is DeFi. And if you look, there's an explosion of yield tokens. Saturn, Apex.
Yep.
You know, they've come out of nowhere. If you go to the Apex website, they had $280 million in value 48 hours ago. They have $320 million right now. They're adding $1 million an hour. Right? So the amount of these companies, they've gone from nothing to $300 million in 8 weeks, 6 weeks. And so I think there's a lot of capital that's going to flow into yield coins that are powered by STRC. And there's $320 billion of stable coins. Why wouldn't there be $50 billion or $100 billion of, how many of those people would like to get paid 8%? How many would like to get paid 24%? And so that formation of the yield coin ecosystem with with DeFi leverage, 3x, 4x, 5x looping, I think that's going to it is capturing the excitement, the imagination of the DeFi community and the crypto community right now, and it didn't exist 8 weeks ago.
Are you concerned about that, how the leverage and the 3x, 4x builds up, and then will probably get incinerated at some point, or it's...
No, I'm not, and here's why. Because we have TradFi degenerates that buy $1 billion and then dump it the next day, and we absorb it. The reason this is going to be okay is we have a $50 billion derivatives market in the equity. We have $3 billion trading in the common spot. We have a $60 billion tower of equity. We have an $85 billion enterprise tower. All of that's damping things before you get to STRC, where you've got $400 million, $350 to $400 million of daily liquidity, and that's going to grow. And that's already taking on, they took on $1.5 billion of stress in March. They took on $3.2 billion of stress. It could have been $2 billion getting dumped on the market, and it still held in the 99 range. And, a few days later, we're $99.97 or something. So, with all these DeFi tokens, there are going to be 1,000 interesting ideas. They're going to grow. But if you look at them as a percentage of all of the trading volume, like the total amount, $300 million, it's $300 million of AUM against $8.5 billion of AUM. If it was 80% or 50% of the AUM and it was in one token, then maybe there would be some risk we would look at. But right now, it looks to me like you're talking about 1%, 2%, 3%. And they're offset by, if you go to BlackRock and Van Eck, we're built into credit indexes of PFF and the like. And for example, there's more STRC sitting like in the credit indexes of the ETFs than there are sitting in the DeFi ecosystem. And so I think we're really well diversified, and we've got that massive retail base. And what's the worst that happens? The worst that happens is what, someone wants to sell $1 billion of STRC in a single day. Has it happened? Yeah. Well, so it might trade from $100 down to $99.20.
Yeah.
And then it snaps back up. Look, during the thing that's the fundamental driver, it's not going to be stretch trading. It's going to be Bitcoin, right? When Bitcoin crashed 10,000 or a coin, right, February 4th, whenever it did, that was the event that caused STRC to weaken, right? If our collateral tower is reduced from 120 billion to 60 billion overnight, that will create a dislocation. But the instrument is designed to be anti-fragile. Right, there are people in the market that if you were to basically place a $75 million market sell order in 1 minute, they would snap up the entire order at a 25-cent discount. Or, if you tried to sell $500 million of it in a minute, it would get bought. It would get bought at a discount. You would be stupid to have dumped it, but the market will buy it, and one person's panic is another person's opportunity. The real key point, this is a very important takeaway. We constructed this instrument so it would be extraordinarily robust, so we can put hundreds of billions of dollars of yield coins on top of it. And the way we did it is we created a perpetual preferred that never comes due. So when someone decides they want to sell $2 billion of STRC, we're not redeeming it. There is no liquidation right. There is no put right. It's not a bank deposit. If I sell you $2 billion of stable coin on Friday, you can redeem it on Monday, and I have to come up with $2 billion of cash and give it to you. But when we sell you $2 billion of stretch, it's a perpetual swap. We're agreeing to pay you SOFR plus a credit spread forever. You're agreeing to give us the money forever. We're playing to hold Bitcoin forever. It's a forever swap, which means that this is the perfect transmission mechanism, because the thing that we've done, which is just a very serendipitous development, is we've created a credit instrument which provides yield to the entire DeFi economy, but the liquidity is being provided by these outside hedge funds, which are nameless, right? The fast money guys that are actually trading it, they're going to step in and buy it at an 80-cent discount to sell it back at par, and they have a lot of capital, and that's what they do, and they like doing it. And so the company is able, what's the difference in the credit risk of $100 billion of overnight deposits and having to pay them back on Monday versus $100 billion of equity that you have to pay back never? Yeah. If you do the calculation, you can see it's 100x more risk. So if you're building a stable coin, you're actually taking overnight deposits. You have to give the money back on 1 day's notice. And that's why bank credit isn't really good credit. Bank credit is, I'll pay you 3% and I'll give you back your principal tomorrow, whereas digital credit is, I'll pay you a spread over SOFR each month, and I will not get, you're an equity investor, and if you want liquidity, the trick is the company's not providing liquidity, the market is providing liquidity. And there's plenty of these people, these traders, they have plenty of money. They need something to do with it. Remember what I was saying? Remember back earlier in the interview, I said, our job is to be trustworthy and transparent. Yeah. There are people that work at Soros and Millennium and Citadel, and they actually want to make a fast trade in a minute or in an hour or in a day. If I agreed to provide all that liquidity and I pegged the entire thing at 100, they wouldn't have the opportunity. Yeah. So there's something in management theory called the shifting of the burden to the intervener. If I actually do it, it means the people with $100 billion of capital don't get to do it. So I would take $100 billion of risk, which is a problem, which would be a problem for the equity, which means I can't sell the credit. And I would deprive them of being able to make a sweet 27% yield every year, or 52% nearly risk-free yield from their point of view every year. And what you learn in business is you have to leave an opportunity for your partners. So we let Bitcoin be Bitcoin, and we leave the opportunity, and no, I'm not trying to get the bottom, I'll buy the top, and you could be the Bitcoin trader, and you can buy the bottom, and you can think you're smarter than me. But the point is, if I was better than you, you would take your money, go home, and quit. I want you to be smarter than me. You could do that. And we let the equity traders do their thing, and we let the options traders short us and go long and do their thing. And then we let the credit traders trading stretch do their thing. And then we let the guys create the yield coins, Saturn and Apex. And it's I could do it. If I did it, it would be a lot of work for me, and I wouldn't be as good as they would. And then I would be robbing them of their opportunity. It's don't hog the ball. Let them do their thing, and then they're going to trade it. And sometimes when you design a building, when you design an airplane, you want to design an airplane so the wings flex. If I design an airplane so they don't flex, they don't flex until they snap off. And the same is true in engineering. The building flexes, because if you try to make the flex go away, it snaps. It's like, okay, you're good until you're catastrophically failing. We've engineered digital credit so there's a bit of flex in it, but it won't snap. Someone gets forced liquidated and they need to get $2 billion of liquidity. It'll flex, but it won't snap. And I would much rather have a machine which is scalable and can grow by 10x and 10x and 10x that provides an opportunity. And when we flex, that's your opportunity. Like we flex, if Stretch trades to 98, I meet people like, yeah, I bought Stretch, it traded down to 94, and I picked the bottom and I let it go up to 100, and then I sold it. It's like, good for you. You did that, and they had the money to do it. Everybody's, they gotta have something to do, right? Everybody needs a business. And so I think the real strength of our company is we have tens of billions of dollars of equity investors, tens of billions of dollars of derivative investors. We have billions of dollars of credit investors. And now we have this burgeoning downstream digital money, digital yield set of investors. And our job is to stand there, do our thing, and then let everybody else dance around us, right? And not hog the ball and not try to get into their business, because we rob them of the opportunity and then we dilute and diminish our own unique competitive offering.
Well, it's currently the 13F filing season, or it's finishing. Is there anyone that's caught your attention, or even when you speak to the banks, asset managers, hedge funds, what are their concerns about, not even just Stretch, about Bitcoin, or are we past that point of Bitcoin, and where are we now?
I think for the investors in Bitcoin, it's like there's a global consensus. Bitcoin is real. The tailwinds for Bitcoin, or the catalyst, will be, a cessation or a resolution to the Gulf War, the installment of Warsh at the Fed, any loosening or any forward accommodation in the interest rate monetary policy, and then any positive developments in trade, right? And all of those are positive catalysts. And then the passage or resolution on the Clarity Act, right? When we get a resolution there, those will be positive macro factors for Bitcoin. For the equity, well, our equity rallied from $120 to $180 in April as we were selling $3.2 billion of Stretch. I think that MNAV's been expanding. At some point, people start to look at the yield and say, well, if the company can generate 10% yield a year, it's going to double its Bitcoin per share every 7 years. If it goes 20% yield, it's going to double Bitcoin per share in 3 years, right? If that's the case, you could justify putting a multiple, whether it's a PDE multiple of 3 or 5 or 10 or 20. But at some point, you put a multiple upon the yield. If you put a 10x multiple on a 10% yield, you can imagine a trading MNAV of 2. And so I think that the equity investors are getting more excited because they see the credit engine is going to drive Bitcoin gains for them. And I think on the credit side, the credit is really in hyper growth mode for the past 3 months. But pick any hyper growth business, like the first 3 months of Apple. How do you forecast, or the iPhone? How do you forecast the first 3 months of the iPhone, or how do you forecast the first 3 months of any revolutionary product? When they start selling robots that do all your work for you, and they sell 20 million in the first 3 months, and you're like, well, what's the business look like? It's going to be hard. You're going to need a couple of years, or at least, a bit more time to figure out where that is. But I think the reaction of anybody that hears about Stretch is, wow, this seems too good to be true. On paper, it's the best credit instrument in the world. In fact, on paper, it's the best publicly traded security in the world. stretches the highest Sharpe ratio of any asset, any credit instrument, any hedge fund strategy that's illiquid, and any equity. And so, you know, your reaction is, well, you know, it looks good. It's just, oh, it's been doing this for 3 months. Come back to me when it's been doing it for 3 years. Some people will want to see 3 years of performance. Some people want to see 10 years of performance. Like, you know, there are people that wait 10 years after Tesla worked before they buy an electric car, right? So how about airlines? Some people waited 10 years after the airline started operating before they're flying an airplane. So you'll have early adopters. You'll have the people that'll do it they want to be booked on the first Concorde flight. You'll have people that are going to wait 3 years and people that are going to wait 10 years. And I think our job right now is manage the instruments, be rational, communicate, educate, and then let nature take its toll, or, you know, let nature unfurl itself, because there's just a lot of natural viral dynamics here. And each month by month, the thing will season, and then people will get more comfortable. You know, it's like right now, the fear and the anxiety is, well, if it's hyper growing, does that mean you're going to sell $10 billion next month and $20 billion the next month and $50 billion the next month? And if you do that, you're like, well, what if Bitcoin doesn't trade up? And what if you hyper sell this? And if the equity doesn't trade up, you know, you can construct all these scenarios where you worry yourself to death because you extrapolate the one thing, but you don't extrapolate all the other systemically related things. And generally in the real world, this has a way of moderating itself. There are natural servo mechanisms or natural feedback loops. If Bitcoin rallies, the credit risk falls, the credit will sell. But if Bitcoin falls, we won't sell as much credit. If Bitcoin doesn't keep up with the credit, the demand for the credit will fall. And so I think that generally the market is going to work all this out, and it'll establish a dynamic equilibrium, which is good for the capital investors, the credit investors, and the equity investors. And most people, they just want to see performance over a longer period of time. It's like Nicholas Taleb has the Lindy effect.
Yeah.
As it gets more Lindy, as it just has a longer lifespan and it's been performing longer, the risk starts to fall off.
The vol falls.
The vol falls off, the support increases.
Yeah, but and it's interesting to watch even this year that MSTR is up 15%, Bitcoin's down about 10%, and since IBIT launch, IBIT's up 60%, MSTR's up 220 to 250. I think as time goes, these instruments are going to start trading maybe by themselves, and everyone just tries to work out where everything's actually going. And I find that, as an analyst, very interesting.
I agree. Like there are going to be capital flows. Like investors will make an allocation to Bitcoin based upon their view of it as a legitimate capital reserve asset. And that's like the native flows into BlackRock. There are going to be credit flows. People will allocate to credit based upon their confidence and stretch in other credit instruments. There are going to be equity flows. Sometimes the equity capital markets rally and our stock rallies and Bitcoin doesn't rally, but that's because there's a lot of capital flowing into that. And occasionally the things get correlated and occasionally they get uncorrelated. You know, Bitcoin was 80 vol in 2020 when we got involved, and it marched from 80 vol to 70 vol to 60 vol to 50 vol to 40 vol. It's pointing toward 35 vol right now, and it's like, it's going to naturally grow up to something, and as it grows up, you know, the pessimist will always find a reason to be pessimistic. It's growing slower, and the optimist will look at it and say, well, because it's growing slower, it's less volatile, there are more people that are going to want to buy it. And the truth is, there's 100 times as much demand for the instrument if it's 20 vol, 20 AR, than there is if it's 50 vol, 50 AR.
I was trading it when it was 120 vol.
It's counterintuitive.
Yeah, it's one. When the ETF's launched, it's now one, and now it's just a process which we just have to wait for, really.
Yeah. No, I'm optimistic.
Thank you for your time.
Yeah, anytime. I appreciate the opportunity.